Video started. Welcome class. Today I'm going to be talking to you about financial accounting. And financial accounting. Accounting is a discipline that is concerned with one, recording, two, analyzing, three, summarizing, and four, communicating what? Economic information. Economic information to who? Financial statement users. We call them users. Now, this is a formal definition of accounting. Most professors, if you ask what is accounting, they're going to say accounting is the process of recording economic transactions. We analyze those transactions, we summarize those transactions, and we communicate those transactions to financial statement users. So we're going to go through each of these things, what they mean, and then you'll be able to understand it, okay? In accounting, when we say we are recording things about assets, things about liabilities, and I'm going to define what they are very soon. And we are recording things about equity. And then revenues and expenses. So these are the things that we are recording. And we are recording them from the perspective of a business entity. So the question becomes, what is an asset? An asset is simply a resource that you own or you have a right to use. The formal definition of an asset is a right to economic benefits. That's the formal definition of an asset. You have a right to economic benefits. But I'd like to explain it with examples. Buildings, cars, furniture, cash, things you can see, feel, or touch, that you own them, you have a right to use them, or you have a right to those economic benefits. When they make money, you get those rights. So you can define an asset by using examples of an asset. So if I tell you, okay, is a projector an asset, would you say yes or no? Exactly. Is a building an asset? Is land an asset? Something that can produce money, economic benefits, or save you costs that you have a right to use. That's what an asset is. Okay? So we know what an asset is. When you increase an asset, we call it debits. An accountant will say a debit when he means that your asset has gone up, it's increased. So for example, if you have cash of $10 and I gave you $20 more, your cash is now 30, your cash went up. So an accountant will tell you, you debit cash because your cash went up. When you decrease your asset, we call that credit. Does that make sense? Good. So we know what an asset is. We know how we record it in accounting. We increase it with a debit, we decrease that with a credit. All right? And let's go on to liability. A liability simply means an obligation to transfer economic benefits. You have an obligation like a mortgage note, a car note, a bank loan, accounts payable, rent accrued. You've stayed in somebody's apartment, but you have not paid for it yet. So that unpaid rent, that bank loan, that mortgage debt, every debt is liability. Every loan is liability because you have to pay somebody. So that's why we define a liability as an obligation to transfer economic benefits. If I was talking to my brother, I'll tell you, you have an obligation to pay cash to somebody. Right? Colloquial language. That's how I explain it, right? Whether you owe somebody, we call that a liability. A liability, when you increase it, we call it credit, and when you decrease it, we call it debit. The exact opposite of an asset, okay? Liability is the exact opposite of an asset, right? And then equity means asset minus liabilities, which also basically means capital that you have invested in the business plus your accumulated profits. So let's say I started a business. When I started the business, I put in $100,000. That $100,000 is what we call what? My equity in the business. This year, I made $50,000. I did not take it away from the business. And next year, I also made $20,000. So now my equity is 100 plus 50 plus 20. So equity could be defined as the capital that I have contributed into the business plus the undistributed profits, or the profits that I've accumulated that I have not taken out yet. And equity, when you increase an equity, we say credit, and when you decrease it, we say debit. Here comes the accounting equation. Asset equals liability plus equity. So the Italian monk who came up with accounting said that, when you have an asset in your business, it's because either you invested your money or you borrowed money. So if I'm starting a business and I invested my money of 100 and I borrowed 50 from the bank, then my total cash, my total asset in the business is what? 150. So this equation, A equals L plus E, asset equals liability plus equity, is the first fundamental accounting equation to remember. Does that make sense? Asset equals liabilities plus equity. We call that, my friend, Ali, right? A-L-E. Don't forget that. Now, if instead of giving it to you in a straightforward way, I gave you that this is 150 and the liability is a question mark and this is 100, you'll be able to manipulate this algebra and come up with what the liability amount should be, correct? So basically, I'm going to now be twisting it around that way. So as long as you memorize the equation or you understand the equation, you should be able to manipulate it, however I ask the question. Now, I'm going to add a slight nuance to it. There is something, now the asset, liabilities, and equities are recorded on a statement that we call balance sheet, BS. Balance sheets. The balance sheet is a picture of all my assets, all my liabilities, and all my equity at any point in time. If you ask me, Kwazi, I want to know your balance sheet as of today, right now. Go to my house, take a picture. I freeze my cash, my investments, my buildings, all of those things. I'm showing you a picture of my assets, my liabilities. It's not a movie, it's a picture at any point in time. So the balance sheet, we say balance sheet as of. Or if you are from England, you will say balance sheet as at. Then you put a date on it. The picture of me at this moment in time. My balance sheet will keep changing, so I don't want you to show me the changing balance sheet. I want to show you to show me at each point in time, how much assets do I have? How much liabilities? How much equity? What a balance sheet is. Does that make sense? Now, we go to another accounting element that we call revenue. Revenue simply means money you get from your primary or central activities. If you are a university, your primary activity is teaching, research, and service. So if you get money from tuition, that is your revenue. However, if the university invests the tuition revenue and they get investment income, the investment income is not revenue. Instead, we call it other income. So we're saying that revenue is money from your primary or your central activities. If you're an insurance company, you get premiums, that's your revenue. If you invest the premiums, we are not, from the perspective of the insurance company, we are not going to consider it revenue. Instead, we are going to say that that is other income. So that's how we differentiate between revenue and other income. If you're a car dealership, what do you sell? Sell cars. You sell cars and you get money, what are we going to call that? Revenue, right? But if you invested the money you got from selling cars and you made dividends or bond income, we're not going to call it revenue, we're going to call it other income. But that's the key. Make sure you understand the definition of revenue. It just means sales. Walmart sells. Target sells. Those sales that they are doing are revenue. A legal firm is going to have what? Litigation fees that they charge, right? Legal fees they charge, and that will be their revenue, service revenue. And whenever you increase your revenue, we say credit. When you decrease revenue, we say debit. Does that make sense? And then last but not the least is what we call expenses. We all know what expenses are, like your rent expense, depreciation expense. The formal definition of an expense is expired cost. And when they say expired cost, it means that you have used the asset. When you use an asset, the process of using it is called an expense. For example, if you use your car, it depreciates. So we call that depreciation expense. If you use a furniture or a computer, it depreciates, it gets older from using it. We call that depreciation expense. If you use somebody's apartment, you pay rent, so we call that rent expense. If you use a person for your business, you pay them what? Salaries or wages. So we're going to call that salaries or wages expense. If you use somebody's money to do your business, you pay them interest expense, right? So that's why we say expenses means expired cost. Things that you have used give rise to what? Expenses. And examples are rent expense, interest expense, mortgage expense, depreciation expense. You have expenses of your own. You know what expenses are when you get your money. So I'm not going to belabor the point. When you increase an expense, we call it debit. When you decrease an expense, we call that credit. Does that make sense? You could see that expenses and assets are the same, and everything else is the opposite. So if you want to learn it, you could learn it by that way. Expenses and assets, when you increase them, it's debit. When you decrease them, it's credit. Everything else is the opposite. Does that make sense? Okay. Now, when we say debit and credit, don't be confused with how the banks use debit and credit. They learned accounting from us and they went and they twisted it upside down. Okay. But don't be confused. You're not looking at it from the viewpoint of the bank. But an important principle to remember, though, is that when we say debit or credit or increase or decrease, we are talking about it from the perspective of the business entity or the person. So whenever you do accounting, you have to put your shoes, you have to step in the shoes of a business. So from the viewpoint of Springfield College, or from the viewpoint of UConn, or from the viewpoint of Mass Mutual, or from the viewpoint of some entity that you work for. Because somebody's credit is somebody's debit. You have to understand that. So if I give you $100 right now, from my viewpoint, my cash is going down. So I'll credit my cash. But from your viewpoint, your cash is going up. You will debit your cash. So if you don't take a perspective, you will confuse debits and credits. Does that make sense? So the first question you ask yourself is, in the books of what entity? From whose viewpoint am I looking at this? And then from that viewpoint, you'll be able to say whether it went up or it went down, and then that's how we do accounting. Does that make sense? Okay. Expenses and revenues are summarized in a statement that we call the profit and loss account, P&L account or profit and loss account. Officially, we call it the income statement or statement of comprehensive income. That's the name of the profit and loss account officially. Okay? So we have two statements, balance sheet and profit and loss account. But those statements are not enough because companies that have high profits sometimes fail. I mean, how can you have so much profit and still file for bankruptcy? Because profit is not the same as cash. The difference between profit and cash is what we call accruals. Accruals are for things that you have used but you have not paid yet. We record them in the profit and loss account, and so we came up with a third statement that we call statement of cash flows. Statement of cash flows, also called a cash flow statement. In the cash flow statement, we ask you to tell us how much cash did you begin with? You say 100. How much cash did you end with? You say 150. And I say, well, the cash went up by 50. Explain to me where the cash came from, those $50. Where did they come from? And they can only come from 3 or 4 sources. We have 5. Okay? The O means operating cash flows. So that means operating. O stands for operating cash flows. That means cash that you received or you paid because you were buying and selling goods and services. Does that make sense? So sales, cash receipts, payment of salaries, those things for your operations. Okay? So the operating cash flow may explain, let's say, 20 of the 50. And then financing cash flows means cash that you either borrowed or you repaid or that you invested in the business yourself as an equity holder. So if I borrowed money from Bank of America, that would increase my financing cash flow. If I repaid my debt, that would decrease my financing cash flows. Does that make sense? All right. So I could say my financing cash flows is 15, and then investing cash flow means money that you receive from selling buildings, bonds, stocks, investments in general, or money that you paid to buy buildings, bonds, stocks. If you paid it, obviously, it's a negative number. If you received it, it's a positive number. So the net of money paid to buy buildings, stocks, furniture, computers, all those assets that you are buying and selling, money you pay to do that is what we're going to call investing cash flow. Does that make sense? All right. And so if you add this, you get 35. And so if this is 15, then 15 plus 15 is 30, plus 20 will give you 50. So that easily explains why your cash went up of 50. Does that make sense? Any questions so far? Any questions? There is another reason why your cash will go up, but that is a very small part of this. So we often don't say it. So I went to England the other day. I had some euros. I brought it home. I put it under my bed. When I came, I said to my wife, Lily, I am going to give you some euros. She said, how much is it worth? I said, well, that's 1,000 euros. And she said, well, let me go to Bank of America and figure out how much it is worth. She went to Bank of America, and then they said it's worth $1.20. So 1,000 euro is going to give her $1,200. She said, well, the currency looks very crisp. It looks very nice. I don't want to exchange it now. I just want to put it under my bed for a week or two and see how the value goes. The next time she went, her cash that was worth $1,200 is now worth $1,500, for example. Okay? So that increase of $300, how do we account for it? We are going to say the effect of exchange rate on cash balances. Does that make sense? Because your exchange rate is changing around you, so your currency is also changing, right? But that one is very small. If you work for a multinational corporation, you will see that. That will come through. But if you work for a local company, they don't have foreign cash balances, so you don't have to deal with that. So in that case, the only thing you have to explain for the changes in cash is going to be your operating cash flows, your financing cash flows, and your investing cash flows. Does that make sense? All right. So what I have done here is I've showed you how to record the stuff. Okay? We've been thinking about them in the process of analyzing them. And how do we summarize them using balance sheet, P&L, and cash statement of cash flows? That's how we summarize them, right? Because if you don't summarize them, we're going to have a bunch of these debits and credits. We will not know what to do with them, right? These are recorded in what we call general ledger, which is a detailed record of all these things. But we want to summarize them into one of these three statements. And when you summarize them, we want you to explain the big things on those statements to us. So we're going to have what we call disclosures or footnotes. Disclosures or footnotes are just explanatory line footnotes explain the material or the big things on the balance sheet, on the income statement, and on the statement of cash flow. So for example, I can take my revenue and try to explain to you, here is how this college makes money from MBA classes, from undergrad classes, from here, and tell you a story about the big numbers on the financial statement that you would like to understand. So I'll put those in a qualitative disclosure. Does that make sense? Explaining it, okay? You can go down the balance sheet and explain cash, go down and explain different things and different things and different things. All right. We have to communicate this information by filing the financial statement or the annual report, or maybe sending an email on the company website, or if it's a public company, you file it with the Securities and Exchange Commission, or you just do the financial statements and you file it with users. Here we are only concerned about economic information. That's what I mean is information that have to do with dollars and cents or cash. So if you read a contract and the contract is not dollars and cents, we can't record the debits and credit because we are concerned with that. But instead, if you like, you can summarize the risks and the other things in the footnotes for us to read it. We can read it that way, but we cannot record information that is not dollars and cents. Or it could be any currency, euros or other currencies that you're familiar with. Does that make sense? Now, another important thing about accounting is accounting provides information to two groups of users of financial statements. We call them the internal users and then the external users, okay? The internal users are employees and management. Management and employees. Management. Employees. These are board of directors as part of management. These are people within the company. They need the financial statement information to do their work. Does that make sense? All right? And then the external users will be people like what? Investors. These are people who have put their money in the company. Creditors. People who have sold goods to you on credit, or it could be bank, or regulators, banks, regulators, or any other interested parties in the business. Does that make sense? So these are external users. So financial statement information that we prepare, we have to give it to somebody to make decisions. And those decisions will be made by the internal or external users. Internal because they are internal to the business, they work in the business. And external because they are outside of the business. So make sure you understand the difference between internal and external stakeholders. I'm gonna ask you to differentiate. Does that make sense? What I have just gone through is what we refer to as financial accounting. This class is about managerial accounting or accounting for decision making. We are going to get accounting information and we are going to use it to make what? Decisions. Our focus in this class is going to be internal information for internal decision making, management or employees. This is not a financial accounting class, so we're not going to focus on external investors. You're not going to do that. Okay, so now let's get into managerial accounting a little bit. But before we do, I'll take a pause so somebody doesn't have to watch this video. Peace out.